This is The Real Story with Michelle Makori.
A break the glass in case of emergency moment for the U.S. economy is coming. That is the warning from former Treasury Secretary Henry Paulson, who was at the center of the 2008 financial crisis. Paulson says policymakers need an emergency plan ready to go for the moment demand for U.S. debt starts to dry up. He says they need to prepare for the moment that investors stop buying U.S. Treasuries, and that the time will come when the U.S. tries to issue debt to fund itself and no one wants to buy it, forcing the Fed to step in and become the buyer of last resort. Now, Paulson says the consequences would be vicious and could quickly lead into a full-blown sovereign debt crisis.
This crisis is different, right? When you hit the wall and you're trying to issue treasuries and the Fed is the only buyer and the prices of the treasuries are going down and interest rates are up, that's a dangerous thing. And so the thing I am talking about now is we know, people say, when are you going to hit the wall? I obviously don't know. It's impossible to know. But the law of economic gravity, you're not going to know that. So, and when we hit it, it will be vicious. So we have to prepare for that eventuality. And I think we need an emergency break the glass plan, which is targeted and short-term on the shelf. So it's ready to go when we hit the wall.
Now, keep in mind that U.S. Treasuries are not just another asset. They are a core pillar of the global financial system. They're considered the risk-free benchmark. They are the collateral behind banks, pensions, and derivatives markets. They are the instrument that the U.S. government relies on to fund itself. And the entire system works on the assumption that there will always be buyers. So what happens if that assumption starts to break? Well, it begins with confidence. Investors start questioning whether the U.S. can sustainably manage a debt load that has now surged past $39 trillion. They begin demanding higher yields, higher interest to compensate for that risk. And those higher yields increase the government's borrowing costs, which makes the deficit even worse, which forces the government to issue even more debt and puts even more pressure on demand. And that is what economists call a fiscal doom loop, a self-reinforcing cycle where rising debt leads to rising costs, which leads to even more debt. Printing money to fund government spending devalues the currency, fuels inflation, and further erodes confidence. And if that spiral accelerates, you hit what Paulson calls the wall. Well, when does it happen? No one knows, but he warns that there better be a plan in place. However, he didn't specify what that plan should be. Now, keep in mind, this is the guy that steered the U.S. through the 2008 financial crisis. But he says this is very different. Now, back then, the crisis was in the private sector. Banks were overleveraged, credit markets were frozen, and the government stepped in to clean up the mess. But today, the concern is that the government itself may be the mess, may be the source of the instability. Back in 2008, U.S. debt was also around $10 trillion. Today, it is nearly 4 times that. And back then, interest rates were collapsing. Today, they remain elevated. Back then, the U.S. had fiscal firepower. Today, that margin is much thinner. Which raises a much bigger question. If the next crisis is in sovereign debt, who steps in to fix it? Now, Paulson is not alone in raising this alarm. The International Monetary Fund is warning that the system is already showing signs of strain, that the sheer volume of U.S. debt issuance is eroding the safety premium that treasuries have historically commanded. In simple terms, investors are no longer willing to pay as much for the perceived safety of U.S. government debt. And at the same time, economist Mohamed El-Arian is warning about a growing imbalance between supply and demand. Too much debt being issued, not enough natural buyers to absorb it. And that imbalance matters because markets don't break all at once. They weaken gradually and then suddenly. And Jamie Dimon has also cautioned that rising debt levels could lead to bond market turmoil that would spill into credit markets, lending, and the broader economy. And then there's Ray Dalio, who takes it a step further. He argues that the real risk is not that the U.S. defaults on its debt, but that it pays it back in devalued dollars, that the path forward may not be default, but debasement. And even Fed Chair Jerome Powell has acknowledged that the current trajectory of U.S. debt is unsustainable.
What's clear is that our debt is growing much faster. The federal government debt is growing substantially faster than our economy, and that ratio is going up. And in the long run, that's kind of the definition of unsustainable. The level of the debt is not unsustainable, but the path is not sustainable. And so it's really important that we get back to, we don't have to pay the debt down, we just need to have primary balance and begin to have the economy actually growing better, growing more quickly than the economy. It will not end well if we don't do something fairly soon. This is not the Fed's job, of course, and I pretty much limit myself to those high-level points which essentially everyone ignores.
So from former Treasury officials to global institutions to Wall Street to the current Federal Reserve Chair himself, the message is converging. Now, to be clear, no one knows when this wall might be hit. Even Paulson says it's impossible to predict. But when it happens, it will be sudden and it will be severe. So what would a break-the-glass plan actually look like? Well, there are no official details, but markets already have a pretty good idea. It likely means very aggressive Federal Reserve intervention, large-scale bond buying similar to quantitative easing, but faster and more targeted, liquidity backstops to prevent forced selling, and even yield curve control where the Fed caps interest rates directly. Emergency measures designed not to stimulate the economy, but to just keep the system functioning. And here's the uncomfortable truth, because none of these measures solve the underlying problem. They just buy time. They just stabilize markets temporarily, but they certainly do not reduce the debt. They don't restore long-term confidence, and they will only accelerate the very risks that they are meant to contain. Because the more the system depends on intervention, the more fragile it becomes. And ultimately, this is about trust. The system works because investors believe in U.S. Treasuries. They believe in the full faith and credit of the U.S. government, because they believe there will always be demand for dollar-denominated treasuries. And because of that belief, the current system holds. But that confidence is not permanent, and once it really cracks, everything changes. So what happens if the world starts to lose confidence in the very asset that underpins everything? When confidence in sovereign debt starts to fade, capital moves. And historically, it moves into gold, an asset with no counterparty risk, no issuer, no dependence on government credibility, a neutral reserve asset. And that is exactly why central banks have been buying gold at record levels, because in a world where sovereign debt itself becomes the risk, gold is no longer just a hedge, it becomes the alternative. And if Paulson is right, if we are heading towards a moment where demand for U.S. Treasuries stalls, then the question is not just what breaks, but what replaces it. And that is the real signal to watch. And with gold now overtaking U.S. Treasuries as the world's largest central bank reserve asset, we are already seeing the foundations of the current monetary system start to shift. And that's the real story.
This is The Real Story with Michelle Makori.